Got it.
There we go.
Good afternoon, everyone. Thanks for joining us again, our second YouTube presentation here for our multi-units that we're looking to help people understand better. We have Steve Ennis from CMLS Lending Services to help us understand better the process of qualifying for such mortgages. So I'm going to hand it over to Steve, and if Brad and I have questions, he'll give us some answers. And if you have questions, let us know and we'll get them for you.
Absolutely. So I'm going to dive right into it. And specifically what I handle here with CMLS is the CMHC insured multifamily. We do have people on our team that look after conventional, but for today's presentation, I will strictly be talking about the insured platform. And I cover everything in Western Canada. So everything Manitoba all the way over to on the island in BC and everything in between. So to start off, it's a minimum 5 units for this platform. If it's 4 or below, our single family reps can take a look at that. As soon as you hit that 5th unit in the same building, then they're going to start pushing their emails to my platform. So the types of property that CMHC is looking for with this program, the far and away the most common is apartment building, and that's probably what most of your borrowers will be looking at. Standard run-of-the-mill apartment building probably represents honestly about 80+% of the business we do here. But the next most common one there is mixed use properties. So think commercial on the main floor, residential up top. CMHC is all about housing, so they try to limit their exposure on the commercial side. So when we're looking at these deals, we want to make sure there's no more than 30% of the square footage and 30% of the income coming from that commercial component. We can still use that income for debt servicing, so these are still really good deals. They just want to make sure the commercial is a smaller part of the building. But beyond that, we can also look at affordable housing where the rents are no more than 30% of the median renter income for that area. We look at students' residences, seniors' homes, and single room occupancy dwellings. So those are where you have shared kitchen and bathroom facilities. And I like doing a quick compare and contrast to highlight the benefits of this program. So if you take away that insurance piece, we're looking at these deals just as a straight commercial conventional deal. I did a lot of these when I was an account manager with the Bank of Montreal. So through that lens, you're looking at maximum 25-year amortization, absolute max, maybe more like 20 years. Rate of probably around 5% right now, and a maximum loan to value of 75%. So with that insurance, the CMHC insurance thrown into that, I can do maximum amortization of 40 years, so stretch it out an extra 15 years. The rate comes way down. We're probably closer to probably around 2.8% right now for a 5-year fixed. And there's no stress testing in my world. I'm doing all my debt servicing based on contract rate, contract interest, contract rate, contract amortization. So those two alone, the rate and the amortization, help lower the payments and allow us to do much higher leverage. And I can actually go beyond 75% to 85% loan to value. So I'm doing purchases for my borrowers with only 15% down, provided the rents have been maintained close to market. But it is a really good program. So as far as the process, really, we don't have any adjudication software for brokers like there is in the single family space. So I do have an underwriting team, an analyst team, a funding team, but really the broker is dealing with me directly from start to finish. So if you have a deal pop up your desk, I'm working with you to go through debt servicing and talk about pricing. And I'm there the whole way, right up until the end, dealing with lawyers for successful close. So even though I have a team, for most deals, you're just dealing with me the entire time. Might have an underwriter reach out to you if I'm worried about something getting lost in translation, but more often than not, you're going to be dealing with me the entire process. So to start off, when you come across a deal, I'm going to ask you for 3 things. I'm going to ask you for the rent roll for the building, and the operating statements for the building, and a personal net worth form. The biggest difference between my world and the single family world is I'm just looking at the income being driven by the property itself. That's what I'm using to justify as high a leverage as I can and to determine pricing. So once I have those 3 documents, I can tell the broker, I can say, okay, it qualifies at X loan to value. Here are all the fees. Here's what the rate will be. Here's all the reporting requirements. Here's how long it will take to get done. And then what I ask at that point is just to go back to your borrower, get the green light verbally, And if they're happy at that point, I release what's called a letter of interest. It's a 2-page document. And it basically has everything on there that we've discussed in terms of leverage, pricing, documents, and everything. And at that point, there's no commitment on the part of the borrower. So they can review that document, decide if they want to move forward. If they're happy, then I get them to sign off on that document and give us a $5,000 good faith deposit. And then we start the underwriting for CMHC. So we'll go through all the documents that we'll need, but we do the underwriting for CMHC and submit on the behalf of the borrower. So then we wait for CMHC to come back to us. Their queue right now is a lot shorter than it was when I first did this presentation up. In the summertime, they were pushing probably 10 to 12 weeks. Right now, they're a very reasonable 4 to 5 weeks just for that certificate of insurance piece. Very reasonable, but still every deal that comes in, I just make sure that the subject removal and the closing time are reasonable. And if we have to start looking at adjusting dates, then we do that right at the start. Last thing I want to do is worry about that at the last minute. But once I get that certificate of insurance done, that's pretty much the last piece of the puzzle. We've collected all the documents before CMHC submission. I have the certificate of insurance piece. I'll give you that commitment letter. Sign up on that commitment letter, goes to lawyers, probably estimate around 2 weeks for lawyer time. It's a little bit longer, especially if there's maybe a holding company in place. But now we fund. So we've chopped down that turnaround time probably to realistically, if all the pieces are in place, like we have the appraisal, probably about 2.5 months from start to finish. And I like going through all the documents here on this one. So most of these are pretty obvious. Purchase agreement, if it's a purchase, it's pretty obvious. Mortgage statement, if it is a renewal if it's for a refinance, obviously. We try to get 3 years of operating statements. We always ask for it. A lot of the times you'll find some of these sellers, weren't the best at bookkeeping. So if we can't get that, usually we have to rely more on the appraisals estimate, which is fine. We'll still ask for the operating statements. Rent roll, very important. If one doesn't exist, if they're easy to create, we have templates on our website for that. Get the leases. These next 3 expenses, I always highlight. They're very important when it comes to debt servicing, which I'll go over at the end of the presentation. So I need the property tax statement, property insurance to see what the annual premium is, and 12 months utility bills. There are other expenses that go into the debt servicing, but CMHC makes our life really easy. A lot of those are just a very simple formula, as you'll see. But those 3 expenses, I need to know what those are for the property being financed. We like to know what kind of shape the property is in. So if I could just get an email saying, yeah, the roof has been replaced or the units have been redone, any kind of improvements to the asset in the last couple of years is really helpful. Appraisal, we need an appraisal before CMHC submission. If it's between 5 and 24 units, that's a requirement. If it's 25 or above, CMHC waives that requirement.
Oh.
So for the bigger buildings, you can save about $2,500 there. The ESA, that stands for an environmental site assessment. That's about a $2,500 report. It gives a history of the subject property, history of the neighborhoods, if there's ever been gas stations or dry cleaners, which have been historically quite bad for polluting the ground, and which direction that there's any flowing happening. So it's quite a comprehensive report. So we get a clean one for those for only buildings larger than 7 units or 7 units and larger. They give us a break for units that are only 5 or 6 plexes. They give us kind of some slack. If you're bringing a deal in and you just want to strip equity out of the property, CMHC tightened up a little bit on this 2 years ago. So they want to make sure that any funds coming out of the property, any insured funds be coming out is going towards multi-housing effectively. So they want to make sure that the purpose is to buy, build, or improve other multifamily dwellings. So if they want to take equity out in order to buy another one, that's fine. That new property, they give us a little bit of a break. It can go down to as small as a duplex on that. They were insuring funds going into stock market, crypto, holidays, and they clamped down on that about 2 years ago now. So that's reality. For the individuals, for the borrowers, the individuals, I need a net worth form. It's pretty simple. 2 years, T1s, NOAs, straightforward. I need just a background on the borrower. That can just be in the form of an email, like what they did for a living, maybe their business for self, why they picked this property in particular, just some basic stuff. We have an application form, also has basic information on there. It's just a 2-page application. I need to confirm some of their assets. So 25% of the loan amount, that's what we'll need to confirm with CMHC. So if it's $1 million deal, I need to confirm $250,000 in real estate or liquid assets, including RSPs. So bank statements, investment statements, RSP statement, mortgage statement, all of that's fine. If they have other real estate holdings, CMHC has this spreadsheet that I provide for all new deals, and just outlines all of their other real estate holdings they have, both the borrower and the guarantor. If they put it in a holding company and it's been existing for a while, it's a couple years old, we'll ask for 2 years financial statements. If they plan to incorporate a new holding company, that's totally fine. We just ask that they incorporate maybe a month or 2 before closing, so we can let CMHC know who the borrower is, because it'll need to be built into the certificate of insurance. But that's totally fine. I'd like to highlight a couple of things here. I like highlighting that holding companies are fine. I know in the single family space, accountants, I always blame the accountants. They're always encouraging borrowers to buy single family rentals in a holding company. A lot of lenders are not okay with that. We're totally fine with multifamily going into holding companies. You know, it's really up to the borrower. Sometimes they put the smaller buildings, 5-plex, 6-plex, into their personal name. Sometimes holding company for the bigger properties, but whatever they decide, it's totally fine. We're pretty flexible with that. There's no maximum door limitation in this space, which I really like highlighting, because every broker has borrowers that come to them with that awful problem where they have 10 properties and no lender wants to finance the 11th or 12th. So I try to encourage those borrowers to start looking into multifamily. They easily qualify for 5, 10, like 5 units, 10 units, or even 20 units, because they easily hit that personal net worth requirement easily. And our credit loves them because they have experience with renters. So I really encourage those borrowers to suggest, or brokers to suggest to their clients to look that way. We have a minimum. This is our minimum, our investor appetite of $500,000. We have no upper cap, but we've kind of put that. Our investors said they don't want to go below $500,000. CMHC, they're much better than they used to be. I got to give them credit. Whatever issues they were going through in the summertime, I think they were dealing with backlog from the spring and some systems upgrades I think they were struggling through, but now life is pretty good. They're probably running at right about 4 weeks right now. Location for us is important. You know, the major centers is fine. Bedroom communities are fine. Really what we struggle with is small and remote. You know, if it's, say, less than 20,000 and it's nowhere near a larger center, then we tend to struggle in those areas. Broker commission, we kind of do it a couple of different ways. We can do either a 1% fee split, which we try to do for the smaller deals. If we start to get over $1 million, what we can do is build the commission into the interest rate. You know, so if you know, if it's we want 3%, our investor wants 3%, we can build them 20 basis points, and that works out to 1% commission paid to the broker right after closing. And so, some of our brokers charge directly, so we have that conversation right up front. So that is everything for this presentation, but I would like to show you guys the debt servicing. You see this spreadsheet?
Mm-hmm.
Okay, perfect. So I just want to run through a deal quickly. CMHC has it set up so you can really do the debt servicing like on the phone. If I have probably 5 different items specific to the property, I can give you a pretty good estimate over the phone. So I just like running through it really quickly. So this was for a 6-plex in Edmonton, 6 units. it grossed $10,000 per month. So it's $120 annually. This is straight from the rent roll.
10,000 is the natural number following 9,999 preceding 10,001.
Sorry.
No problem. My printer was going off behind me. I'm not sure if you could hear it a minute ago. And I'll look at the vacancy. Edmonton vacancy, 5% vacancy is probably a little bit low. During COVID, it spiked up to around 9%. The CMHC was always okay with us going forward with 5%. So we deduct 5% off the gross income that comes with a fancy term, effective gross income. And you'll see why that's important in a minute.
Okay.
It's very important to note that if there's any parking income or laundry income from the property, I can include this. As you can see, there's a couple spots here for that. And for some of the smaller units, that can go a long way when it comes to loan to value. So then down here a little bit lower. So the yellow boxes, earlier I was talking about specific expenses that we have to get the actuals from the property we're financing, and that's the yellow ones here. So I need to confirm property taxes, insurance expense, and the annual utilities. The rest here, the green ones, those are just a simple formula that CMHC allows us, and they update it annually. So for repairs and maintenance, actually I've got it all here. So I'll take the Prairie region. Most of the smaller multifamilies are wood frame. So you can see here that stands for maintenance and repairs. It's $750 per unit. You know, some years, it'd be really low, some years really high. So CMHC just kind of wants to smooth it out. So they do $750 per unit. Salaries, $450 per unit. Even if these are self-managed, we have to include these for debt servicing purpose, because the way CMHC looks at it is what happens in a default situation. Hypothetically, if there's a default situation, the first thing CMHC or any lender is going to do is put in a property manager with an on-site caretaker. So they can include $450 per unit, 4% of the effective gross income for management, and other miscellaneous costs of 2%. So you can see that built in, it's built into the green one. There's actually also, an appliance reserve of $100 per unit. So this gives me my starting point with income, with my net operating income down here. Yeah, the first time you see this, it might seem a little bit complicated. You do it once or twice and you'll see how straightforward it is. The good thing about this, if a broker calls me, he's on the road and he has like the location, the gross income, the number of units, and those 3 expenses, I can do a pretty accurate debt servicing on the phone. And so it's really quite simple after you've done it a couple of times. So let me come down here. So now I'm going to type in, this is an older building and the remaining economic life was still 40 years. So what CMHC does, they look at the appraisal, whatever the remaining economic life is, they back off 5 years, and that's your max amortization. So in this case, it was 40 years. So we got away with 35 months. And let's say pricing right now is around 3%. Now I'm going to juggle the principal amount and make sure that the debt service coverage here stays above 1.1. So for 5 and 6 units, I can get as low as 1.1. For 7 and above, it's a minimum 1.3. So I go a little bit higher. Right. So on a debt service basis, this deal qualifies at 1.45. But I picked this deal specifically because there's other considerations. I'm not sure how comfortable you guys are with cap rates. Brad, you might be. Karen? No, Karen? Okay, so cap rates, it's what appraisers use to determine market value from an income producing property.
Yeah.
So it's simple calculation. It's net income divided by market value that gives you the cap rate. So the appraisal will go around, look at recent sales, and he'll calculate the net income. So he'll say net income divided by sale price equals the cap rate for that building. And I'll do it 10 times in the same area for the same asset class, multifamily. And in his report, he'll say, okay, based on my research, the cap rate for this area, for this product is, let's say, 5%. So then we'll do that calculation here. We'll take the net income of 74,900 divided by 5%. And that'll give us CMHC's estimated value.
Okay.
So, and in this case, it doesn't always impact it, but this case it does. So I like to highlight it. So CMHC has an estimated value of 1.5 for the building. So I can only go up to 85% of 1.5. So while the debt servicing alone has 1.45, I can only go up to 1.274 on this property. So when I put a 1.274, debt servicing gets stronger naturally, and it keeps us within that 85% loan to value right there.
Okay.
Yeah, that's it. So I'll come back to you and I'll say to the broker, I'll say, okay, the best I can do for this property is 1.274. That's a little bit lower than they originally asked. If they have the additional funds for the extra down payment, then at that point, and they're happy, I'll issue a letter of interest and we'll start going down that path. Mhm.
Sounds pretty interesting and fairly easy to follow here as far as that goes.
Yeah, the
Yeah,
only thing, if you're not used to cap rates, that can be take some time to get used to, but it's pretty straightforward.
Yeah.
There's actually one other thing I wouldn't mind. There's a new program with CMHC. I wouldn't mind sharing. Yeah.
Before you jump off this screen, would you mind just explain? I had a couple of questions. Just explaining debt service coverage and what that means specifically for a borrower.
Sure. Yeah. So effectively, what we're trying to do is you're generating so much income, you're taking away so much expenses. At the end of the day, how much money you have on an annual basis. The way to look at it is CMHC, for every $1.30 of available cash you have on a monthly basis, on an annual basis, CMHC won't allow you to have more than $1 of debt payment. Is how it works.
Yeah,
that's kind of how it works. That's the, on the single family side, you have TDSR, GDSR. In our world, it's debt service coverage.
Right.
That's kind of probably the simplest. So there's a little bit of a buffer built in there of that 30 cents. Except for that's for properties 7 units and up. So for 5-plex and 6-plex, for every $1.10 of income at the end of the day, you can have $1 of debt. So it's like a lot thinner there. So that's actually like it's a benefit that CMHC is allowing us.
Okay.
Yeah. It's just our way of determining this building is generating so much cash. How much can it support on a monthly basis? And what does that translate into an actual dollar amount that we can apply for?
And practically speaking, that's just so that in case there's higher than unexpected vacancies or an unexpected expense or something that comes along, the lender wants to make sure that there's still going to be enough money coming in to cover their debts, right? Yeah,
when we're going through the underwriting, there will be a break-even point. So it'll say, okay, this building, as long as this building maintains an occupancy of say, 70, 60%, they're still going to be able to make their payments.
Right.
We kind of go do a deep dive into that.
Great, thank you.
Do you guys have a moment for one exciting new platform CMHC is rolling out?
Do we, Brad?
Sure. If it's exciting though, I don't want to see any boring stuff.
It is pretty. It's pretty exciting. This one, it hasn't. I've just got a couple screenshots because it will be rolled out on March 7th.
Oh.
So can you see this one?
Yeah.
Fairly.
Yeah, sorry, there's a lot going on here. So, start by looking at the top half, and you can kind of see there's 3 buckets, as I call it. So with CMHC, what they're trying to target here is 3 things essentially. So the first bucket is affordability.
Yeah.
And the second bucket is energy efficiency / climate control initiatives. And the third bucket is accessibility. And accessibility means someone with mobility issues, how much their unit is outfitted to make their life easier. You can make specialty cabinets. You can make adjustments to the bathtub and to the toilet to make their life easier. So when a deal comes in, I can look at that market, and what I will do is I'll determine what the median income is for renters in that market. I'm going to take 30% of that and then divide that by 12. And then, so that'll give me like $1 threshold. And then I'll look at the building, and if all of those units are below that threshold, then you can see here, I'm getting to 80% of the units at 30% of median renter income. You see that?
Yeah.
And that is associated with 100 points. And it maxes out at 100 points. So if the borrower commits to 10 years to keeping those rents below that threshold, they can qualify for a 1% premium, which is really low. Normally it's 5%, up to 95% loan to value.
Oh, wow.
Yeah, it's exciting. They get that low debt service coverage of 1.1 that's normally reserved just for 5 or 6 unit apartment buildings. And they get up to 50-year amortization.
50
years,
wow.
Yeah. It will still be limited by the remaining economic life of the property, though. That's just one. They should have a little asterisk there. So that calculation of remaining economic life less 5 years still applies. So that's just it. Then they can get it. So that 100 points is kind of what you try to get. If you fall short, if you hit 70, you still have some benefit. Hit 50, you have benefit. But you can achieve those 100 points by just affordability, or affordability and energy efficiency, or all three.
Wow.
Yeah, it's an really interesting program.
Cool.
Yeah.
There was something that I wanted to go back to quick.
Yeah, sure.
I know we're kind of running out of time here. So the one thing that overall, for our clients who are looking at investing in multifamily buildings versus purchasing a primary residence, the big difference is that the building itself is what's going to qualify for the financing, right? It's not about like, as a lender, you're going to look at what their personal net worth statement is, but it's how well is that building cash flow? How much money is the building producing in order to cover the debt? It's not just based on,
clients,
like you mentioned, like a total debt service or something personal. It's all based around the building.
Yeah, that's right. And that's honestly, that's for better, for worse. If the seller has been maintaining the rents, really well, and it's go out market, great. In certain markets, that allows us to easily get up to that 85%. Where we run into problems is when they're not at market rents. Like the owner has been, for whatever reason, maybe he's developed personal relationships with the tenants. You see that quite a bit. And so the building is under rented.
Yeah.
So in that case, unfortunately, we still have to go with the actual rents. We can't go with market on those. So you'll have a great property, lots of potential to increase the rents, but it might only qualify for 80 or 75% loan to value. So.
Yeah, that's something that I mean, I see that a lot. It's where either the owner has had it for a long time, or they've got really good tenants and they don't want to run the risk of getting somebody out. But like you said, then your markets are below, or your rents are below market value, and now the building is worth less essentially, because even a difference of $50 or $100 a month in rent makes a big difference in the value of the building.
Especially for some of those smaller buildings, 5plex, $100 a month goes a long way.
Yeah. Wow. Awesome.
Okay.
Perfect. Any other questions, Karen? Or did I?
Well, it seemed it's more, now that you've laid it out, it's easier to understand. So like Brad had said, we're not solely depending on the client's actual personal ability. It's helping clients understand the buildings that they're buying is what's going to play a big role in
Yeah.
what they qualify for.
You know, it honestly, it makes my life a lot easier. I don't have to worry about, as I sit on presentations with single family, and there, you know, there's so many rules. You know, if it's commission income, you got to take twice a year. You know, if it's casual, you can't use that. If it, you know, the child tax benefit, you know, there's so many different ways that people can earn money and how it qualifies for a single family mortgage. In mine, it's just easy. You know, the only thing I can't do is, and this is because of CMHC and for obvious reasons, is anything short term.
Okay.
You know, that's obviously geared towards tourism, and CMHC is helping long-term family. And so their minimum is when they sign a new lease, minimum 6 months.
Okay.
Yeah, once it's been around 6 months and goes to month, that's fine. But they're just really trying to avoid any short-term tourism oriented buildings.
Okay. Well, I don't have any other questions. Do you, Brad?
No, I think that's
Not at the
it.
moment.
I definitely think this is something that we can get into on a regular basis, though, just as things change and as rules and what needs to qualify or what kind of things you're looking for as a lender, though, as those fluctuate. It's always good to stay on top of it so that our clients know if there's a change or if something is going on, that they have the most recent information.
Yeah, absolutely. Yeah, I'm fortunate my world doesn't change that much. I'd say maybe once every 2 years CMHC just decides to do something new, but like this new program. But my world's pretty stable. But if questions come up, I always encourage them. You know, half my day is fielding calls about questions or getting back to emails. So I just tell people fire away.
Right on.
And you
Well,
know what,
I'm
we
really
did it.
super
3 minutes
excited to
left.
be able to work with you that way too. Yeah.
Yeah, we've connected before, Karen. I'm glad we were able
Yeah,
to do
we
this.
have.
Mhm.
And like, you know, the first question a lot of people ask on multi-units and getting it with it being insured versus not insured is the rate. And you're saying 2.8, that is a phenomenal rate for that type of product.
Yeah, they do have, obviously they have the premium, but that's amortized. So that can work out to, you know, as low as $30 per payment. And when you do, it doesn't take much math to see how quickly you make up those savings from that premium.
Brad, do you come across a lot of people that have like, you know, more than 8, 9, 10 rentals and maybe just kind of start driving them towards the multi-units? Because I liked Steve's comment in saying, because we have a tough time when on the residential side, we're basically on putting all these properties in, and the lenders are coming back and saying they're too rent dependent.
Yeah.
So that's why I think the multi-units are going to be huge for a lot of people as they venture out in that investment area on real estate.
Because in the real estate, their only alternative really is to go into commercial, and going into industrial, office, or retail spaces, that's a big jump when they're used to residential, and you're not getting 85, 75 loan to value on commercial properties. Best case scenario is 65. So you have to put a lot more down.
Yeah, definitely a different animal.
It is very different. Yeah.
Yep. So if we don't have any more questions, I just want to say thanks, Steve, for all that valuable information. I know where to go when I have a question, and you're really quick to answer.
Yeah, please do. I know I pack a lot into those presentations. So if you forget anything, no problem. It's a lot of information. And we did it with under 2 minutes to spare. That's amazing.
So again, thank you. And thanks everyone for joining us. Remember to check in on us next week. We'll have another speaker and some more valuable information. Have a great day.
Yeah, thanks so much, guys. Take care.
Bye.